Good morning. It's your friend Scott Bennett. It is Friday, December 12th. I hope you're doing okay. I think if for all of us collectively, if we were to look at our accounts yesterday, the day before, it was great. And today, unfortunately, is a pullback day. So there's par for the course. And I feel like every 3 weeks, the market has one of these types of AI tech shock days. And that's why we've positioned a large majority of our holdings to more commodities, to more stuff versus the tech AI trade. But the reality is we've had some really great winners and we still have some half positions. So we're going to feel some of the volatility today and just want to let you know that we're watching everything closely and we're following our process. And that's the mission of today's video is to go through that and talk you through what we're seeing with our invest with rules process. Let's dive in. I have a couple things to share with you on today's video. Before we do, world's quickest disclosure. This is just information. It's not a direct solicitation to go buy or sell anything. Please always manage your risk, manage your plan. There's a lot of risk out there today, but that's just one day over the course of a really strong year. So let's actually look at that first. So here's year to date, and we're looking at the S&P 500. It's up over 16%. International stocks have had a more significant year, up 28%. Gold, talk about a great year for gold. Happy to be in gold, happy to be in silver, happy to be in gold miners, silver miners, copper miners, the whole works, up 63% in gold, physical gold year to date. And then there's Bitcoin, actually down for the year. So not pleasant at all. This past week, we got the Fed, they lowered interest rates by a quarter point. I think the most interesting item was that whenever part of their balance sheet, their bonds mature, the Federal Reserve and the Treasury were just letting that bond not reinvest. And moving forward, they're going to be purchasing short-term treasuries. So adding more support for the banking system, adding more stimulus to the market. So this is you're having kind of economic growth despite volatility, and you're slowly, not yet, but on pace to get some slow but slightly rising inflation numbers. That's a healthy environment for the market. The labor market looks pretty lousy, which is why the Fed is coming in to cut rates. Let's look through some charts. Before we do, let's go to the market health. So I'm at Invest with Rules, and I'm in the live sheet, the market health section. One thing that you'll stand out is despite just this one day shock event, the stock market score is still a 9 out of 10. We're still in a healthy uptrend. We are exposed to a diversified set of uptrends, and if it's not an uptrend, you will see us take action and follow our process. Our beta, our portfolio is less than the market. The market's a 1, our beta is 0.9, and our portfolio heat, which we watch very closely, is 5.1. Before I get into the signals, let's just look at this trend roadmap chart. Our process, on good days, bad days, this trend roadmap process will have us moving capital into these green advancing phases where you have roughly the 30-day uptrend and a year uptrend. So you have a multi-time frame uptrend, which is a very healthy part of whatever investment you're looking at. There will be times where there's pressure and it moves into a short-term downtrend within a long-term uptrend. And then there are stage 4 declines where you have both the short-term and the long-term down. So we want to minimize positions as quick as we can because things can get difficult and things can get ugly in that scenario. So going back to the market trends, you have over the past 2 weeks, you have strength in gold, you have some kind of moving to the left, but strength in healthcare, materials, which is where we have a lot of our exposure. And what's been acting really weak has been real estate, Bitcoin, utilities. We have very little to almost no exposure there. If we look at the mega cap techs, you're getting the market had a very poor reaction off of Broadcom's earnings, great sales, great outlook, market could care less. That happens. Google and Eli Lilly acting the strongest. There's still a lot of green here. And Oracle is a good example of we had a position, we cut it quick, and things got a whole lot worse. So that's why we follow our process. So we'll look at a couple of charts in today's Where Are We in the Markets. Let's look at Oracle just for a minute. So we cut right around here on the coast signal. Here's Oracle, and we're looking at Oracle daily chart. This is a trading view chart. We're just testing and applying our trend roadmap on this because it's a whole lot quicker than Google Sheets. And if it's in green, it's a gas, yellow, it's a coast, red, it's a break. And Oracle fell really hard from 284 and now it's sitting at 189. And that's why we follow risk management. The lines on the chart, just if you're curious, the green line is the 21-day exponential moving average, the red line is the 50-day simple, and the black line is the 200-day simple. And if there's an overheat, you'll see an orange box. And we do have this kind of green triangle, which to us it says, okay, this deserves some additional of our attention on a gas signal. So let's move over to the S&P 500 and what we're looking at here. We had a cup. We tried to test yesterday all-time highs, and today was a down day on lighter volume, came all the way down to the 21-day exponential moving average and held it and bounced and reclaimed it, and it's now back in the chop. So the S&P 500, 500 stocks market cap weighted, to me this looks not perfect, but it still looks like a healthy uptrend. It's on a gas signal, it's above all of its kind of key moving averages, and you haven't broken up and out. So this isn't the leader, and this is why we kept a half position on things like SPMO and the NASDAQ, which we'll look at. This is getting hit harder today. So you never got close to it with the tech stocks or the NASDAQ 100 or SPMO. So you can see how it doesn't look as healthy as the S&P 500. Volume's a little bit higher. You slice through the 21, you slice through the 50-day, and then you reclaim the 50-day simple moving average. It would be okay and normal if it were to hang out here. If it does roll over and become a coast signal, we are already at a half position, but we'll certainly manage risk and manage our stops the whole way through. Small caps. That looks a whole lot better. So you have broken out to all-time highs. You broke out on nice volume, and it wouldn't surprise me on an overheat yesterday that it comes in, sits down on top of this structure before it maybe makes another room and kind of blast up and out. This is still a healthy market. This is not a terrifying market despite some of the additional volatility. International, I would say it's close to the all-time highs. This looks a little bit better than the S&P 500, better than the NASDAQ 100, not as good as small caps. We have a half position on VEU, a half position on international momentum, and you have a very light volume day to day, and you're still well above moving averages on a gas signal. This still looks perfectly fine. I would assume this would still trend maybe sideways and then keep climbing higher. Everything here looks pretty healthy. So level one, we do have some half positions, but overall looks pretty healthy. And if you look at some of these stocks on a day like today, level one or some combination of level one and level two, having some exposure to precious metals, I think is normal. It's hard to say what's a recommendation, but I would say is normal if you're looking for less volatility than individual stocks. And we'll look at some volatility that just happened. Gold looks a-okay. It's on an overheat signal, but this is really constructive. You had an amazing move, you had a consolidation, and you're working your way back up to all-time highs. So gold up today on a down day. Tech down, gold up. There's not a lot up today. Maybe a select number of healthcare names, some food names like retail food, some cannabis names, but it's been everyone, every sector, every area is getting hit today. I would say what's been doing superbly up until today has been things like silver miners. It's been at the top of our rankings, so it had an incredible run for us. And we did some selling into strength, and then now we had the pullback. We reloaded, cup, handle, breakout, and today's totally normal, just sitting right on top of the structure on a gas signal. Looks really strong. Silver looks even better. It has blasted up out of this cup and handle on an overheat. It would make sense for it to fade, chop sideways, maybe have it come down to the 21-day exponential. That would be normal. But so far, it has been red hot precious metals, and today's just a little pullback on lighter volume. I want to share this ticker with you. Now we're on level three individual stocks. These are stocks that the funds either were accumulating or holding along with trend. Dollar Tree. Who on earth would have thought that we'd have a road tripper? So if our risk is, let's say, 5% and we make 15, so we make three times our risk, that's a road tripper, then we can loosen the stop. As things are just costing more and more everywhere, Dollar Tree presents an opportunity for people's monies to work a little bit harder. And it's fractionally down 0.25% today, comparative to the S&P or the Nasdaq, almost down 2%. It's been a kind of a big run from its May lows. It formed a tough consolidation and it's just been running straight up. So that's been working nicely. This is never fun. You purchase a stock and then the next day it gets hit hard. That's totally normal with stock investing. It's never fun. There's no perfect way to prevent that in any capacity. I wish there was. But this is a great company. The funds are accumulating. You're still on a gas signal. It had a gap up on earnings, and you're forming a nice little kind of consolidation phase. Today is just a really volatile day, and it undercut the 21, undercut the 50, reclaimed the 50, and back in that consolidation range. So it would make sense that it could, as long as today's volume's a little bit heavier, but could it chop sideways? And this industrial play, could it continue to work its way higher, get back over 1,000? We'll manage risk if it doesn't work out, but I think that's so far we're watching that one closely. Franco-Nevada FNV, so in the royalty gold miner space, up on a down day. Obviously, it's not up as high as it was this morning, but working its way to all-time highs on a gas signal. The trend is working great. GE Vernova. We follow our process, and sometimes there's a little bit of probabilities and sometimes a little bit of luck. So we added to GE Vernova on the 9th. The very next day was a great announcement. Increased dividend, increased buyback, increase the forward guidance at their investor day. And it shot up, I think it was 15 or so percent. And so far, the pullback the last 2 days is very constructive. You held the base as of October, kind of undercut and reclaim this top area, and then you're back in that gap up area. So this sets up an opportunity for those that didn't get GEV to pick some up down in here, and where you had a really quick gain. Rocket, I don't expect interest rates to sink like a rock, but they are coming down. The Fed chair is changing likely, and there will be some version of refinancing, and Rocket is proposed to be the winner. And the funds like it and the trend likes it. It's on a gas signal, a very light day today, light volume above the 21, above the 50 on a gas signal. This is a normal consolidation, and could it work its way up and get back up to the high 22s? It has expectations for massive growth next year. This is the most painful thing we own. We have a half position, and if you do the math, if you have a half position, so 2.5% for us, this is why we don't, like, as much as the internet says they're heroes, everyone's like 50% positions. If that happened, that'd be horrible. But if it's a 2.5% position and it's down what it's down today, that's like 0.3% impact to portfolio. Not fun, but very minor. This is a very fascinating company. The funds are here. So it's below the 21, it's above the 50. It is a volatile stock. That's why we position size half, because of the average true range. Could this thing sit back down on the 50 and then boost and rip back higher? It's possible. We'll manage risk. This may be a short in and out exit. We just don't want to wake up and be somewhere down over here at 140 and be like, gosh, I should have got out. That's not our process. And then finally, Taiwan Semiconductor. We don't have a lot of tech exposure, but this is a cup. Now you're starting the handle on lighter volume. You're holding the 50-day. Again, there's some parts of your portfolio that are going to hold things up. There's some parts that are going to be challenged. This is a company that the funds are really going after, and the trend is still holding for now. You're just in this consolidation range. Okay, so I'm going to peel it back here and hopefully make this kind of come to you with what we're looking at. And again, everything of us that we present is based on math and trend and our process. So if we follow big money, we follow the trend, we follow risk management rules. We've had a very solid risk adjusted return year. We are always working on new strategies that are some that are more aggressive, some that are even more conservative. But if you have questions, reach out to us, hello@investwithrules.com. Pretty wild, right? Like Tuesday, Wednesday, Thursday, it's like euphoria, and then boom, Friday. It's just par for the course. It's a marathon. And by following this process, we'll manage risk and we will outpace and do as best as we humanly can, outpace inflation, do well, and while not having that really challenging experience that comes with those bear markets. Enjoy your weekend. Try to stay away from the screens. And you can do this. If you need any assistance or questions, just reach out to us. hello@investwithrules.com. Take care. I hope this helped you identify some uptrends or things coming to uptrends, but please always do your due diligence, manage your risk tolerance. This is not a direct solicitation, just things for your watch list. I hope it was helpful, and I'll see you at investwithrules.com.